Okay, welcome back. And yeah, now I lost my train of thought. Well, let's just start with business taxation part 3 and continue with some words about the German trade tax that is called in German Gewerbesteuer. And we have already spoken about some basics, and now the next usual question is, as always, who or what is liable to trade tax and in how far does that tax liability extend? Well, we are here, trade tax, now the second sub-headline or sub-chapter, and we just immediately go in medias res, as Latin people would say. Well, who or what is liable to trade tax is determined by paragraph 2 Gewerbesteuergesetz or Trade Tax Act. I would recommend to English-speaking people to use the abbreviation like it is written here in German, but as the word or the abbreviation is probably difficult to pronounce, then to speak of Trade Tax Act or so when you read aloud the abbreviation. You should not change the abbreviation because that's the official, widespread and everywhere known abbreviation for Trade Tax Act here, so please use that. Okay, now let's have a look to that Trade Tax Act, and in my translation at least, 2.1 Gewerbesteuergesetz runs as follows. The trade tax is levied on every business as far as it is run in the inland. The term business in this context means a business as defined by the ESTG, so by the Income Tax Act. A business is run in the inland as far as it has a permanent establishment in the inland or on a ship which is registered in an inland ship register. Now that makes us a bit wiser, and so let's analyze what we have read here. Naturally, let's ignore the ships. So from this paragraph we can draw some nice conclusions. First, a trade tax is only levied on the income from business from the inland. So naturally, there will then be no distinction made between an unlimited and a limited tax liability. So imagine you write later a case solution and you write something as you are used to about unlimited tax liability. Then that's completely head off. Decapitation is needed. Then that is death, because that directly proves you have never become familiar with even the first step of a trade tax case at all, so you would directly disclose absolute non-knowledge to a reader. Here, there is no distinction between unlimited and limited tax liability. That makes sense, because otherwise, imagine you had an unlimited tax liability. So you tax the worldwide income. What would that mean? Imagine you live here in Germany and you are the owner of a shop in Paris. Then, under an unlimited tax liability, Paris, the city of Paris, would be granted by German law a right to levy a tax on the profit from Paris, which entirely makes no sense. The municipality of Paris would neither be willing nor be able to levy a tax according to German laws, because that would conflict with French laws, and they would not even know it. So chaos would be programmed. That is why trade tax, as a tax levied by cities, can naturally only be levied by German cities, and so the tax base will be restricted to what happens or refers to Germany. Okay, now after conclusion 1, let's draw conclusion number 2. As the wording clearly shows, trade tax is levied on business. It's the business what is taxed and not the owner. That means that trade tax is designed as a tax on a thing, the business, not on the person who owns the business. So, perhaps there are taxes on houses, taxes on cars, taxes on tobacco, blah, blah, and so on. So the idea is the focus of the taxes. We want to tax the business as a source of income, not to look to the owner too much. And that explains why, in contrast to what you do under income tax law, there you ask, is a person single or married? Does that person have children? Is that person sitting in a wheelchair or not? So are there extraordinary personal hardships to cover? Have there been special personal allowances which can be deducted from the net income, let's say the costs for study or the like? All that is left apart and completely ignored when it comes to trade tax. Here they say this is a tax on the object, on the business, and not primarily on the owner. The only thing where the owner counts for is the owner gets the tax notice, please pay for the business the tax. As the owner of a car gets the tax notice for the car tax, but nobody asks if the owner is married or not, so the car tax is as an object tax only defined by looking on which car, which qualities or characteristics does the car have, and so on. The owner is out of the game usually. There is a special term for a tax like the trade tax or the real estate tax, also levied by cities. That's called real tax, in German Realsteuer. That does not actually mean that the tax is more real than other taxes. It comes from the Latin word realis, which means referring to a thing. Res, Latin, is the thing, and realis is referring to things, in contrast to personalis, referring to persons. That term Realsteuern or real taxes is in German literature, however, only used with reference to two special taxes levied by the cities, both, that is the trade tax, where we are talking about now, and the real estate tax, that is a tax on house property or land property, which you have regularly to pay to the city where the land or house is located. Yeah, so number 3. As the business is taxed and not the owner, that leads to the interesting conclusion that if one and the same person owns several things which are different businesses, then that owner needs to fill out different tax declarations because this will be different trade tax cases. So if John Smith has a fable for baking bread and therefore opens a bakery as a sole proprietor, then John Smith has one business, a bakery. Now, if John Smith later inherits the shoe factory of his late grandfather, and this shoe factory is now also a sole proprietorship of him, then Smith has two businesses, and these are clearly different businesses. So for trade tax, we have two different trade tax cases to solve. And a logical and most important consequence of this is if you have a loss in the shoe factory and a huge profit in the bakery, then you cannot offset the one against the other because these are two different trade tax cases, two different tax objects. Now, on the other hand, if you have one single business which is run at several places, that's possible. Then there is nevertheless only one business. Imagine John's Bakery is located at several places. His business model is there is a factory where the bread is baked. Can one call it a factory? I don't know. But a production hall with an oven and so where all the bread is made. And then he has different selling points across the city and across the neighboring villages and cities. So let's say, to make it plain and simple, he has a production of the bread in city 1, and then he has selling points in cities 2, 3, and 4. Now, this is clearly, if you have a look to its organization, only one single business. But permanent establishments or selling points or production points are in different cities. So what happens here will be, we have one trade tax case, there will be one trade tax base determined, and later every city involved where the business is run will get a certain share of that trade tax base and can tax it. Now, naturally, the question is, how can the line be drawn? Where is the turning point where you can decide this is still one single business or these are two different businesses? Then one will probably look to the organization. In my first example, we have a shoe factory and a bakery. We have a completely different management. We have different places. There, it's a clear decision. In the case of our bakery, we can also say this is clearly one business because there's only one production point. There are different selling points. The organization is the same. Everything seems to belong together. Now let's imagine something slightly different. You would have a complete bakery with oven and all the like at city 1, a complete other bakery at city 2. Then probably one would more ask for the organization, let's say the same management from the same place, the same accounting, and so would probably point to view it as a single entity. In real life, law, administration, and judges would say that depends on the overall impression resulting from the single case. So, who has the better arguments can convince the judge will win. In real life, such examples where you can't draw the line clearly are not likely to happen, by the way. A good tax advisor will always make clear lines so that there will be no doubts arising. Yeah, number 4. Now, the law says the business is taxed, not the owner. That could bring clever people to a very clever tax saving idea. Imagine you want to open up a bakery, and now you know, or you hope, you will have huge profits, let's say 100,000 a year. Then you will have to pay trade tax on these profits. Now, you will try to lower that trade tax or save it. And so you could look around. Hey, there's a nice location, but the old John Miller runs already a bakery there. And well, the old John Miller has completely ruined the whole thing and drowns in losses. So you might knock on the door of John Miller. Dear John Miller, here I am, John Smith. I want to open up a bakery and in the near surroundings. And John Miller, be assured, if I open up my bakery, your bakery will be completely bankrupt. By the way, I heard it's already bankrupt. Now, what about handing over your bakery to me for a decent small price? Because then I would carry on your bakery, which is at the moment bankrupt, would bring it up again, make profits, and I could take over your loss carry forwards. Imagine if you could just continue the bakery of, or the shop of, or the business of somebody else who had losses. Then you could earn money during the first years of your activities without paying trade tax, using the losses of your predecessor. And that would probably mean that no intelligent person would ever try to open up a new business. They would all look for bankrupt other ones just to take them over. this is not really what the legislator wants by a loss carry forward. And so they said, okay, we are taxing the business. And so how can we get out of that trap? Plain and simple, we just write a clarification of the situation. We just write down, if in case of a business the owner changes, then everything ends. The old business is then terminated, and the new owner always begins from scratch. New file. Huh? This is deemed to be a completely new business. So all the loss carry forwards of John Miller are automatically erased at the moment when John Miller sells or hands over to John Smith. That means it makes no difference if you start completely a new business or if you take over an old business. The history of the old business is always wiped out when the owner changes. So this way you can avoid taxation. Allow me 2 remarks. One is already written there on the chart. If a partnership owns a business, then the partnership remains under civil law the same institution if you change 1 or 2 or all of the partners. That would allow, again, a trick. You could, by buying yourself into a partnership, take over a part or nearly all of the old owner's loss carry forward. So there is a special legislation which says, with regard to the loss carry forwards of a partnership, if one of the co-entrepreneurs is exchanged for another, then that part of the loss carry forward, which refers to that co-entrepreneur, is wiped out and the new one begins from zero. So unfortunately, that chance is gone, and that naturally makes sense. Yeah, what was the second idea? The second idea is that fiction, that when the owner of a business changes, that automatically means the old business is terminated and a new one is begun. That can also bring along a huge risk for a sole tradership with a loss carry forward. Imagine, for example, you have, or even for a partnership also, imagine, for example, you have an owner who suffered some losses, let's say 200,000. Well, now this owner has the chance to bring up the business again and earn 200,000 in the next years without having to pay trade tax because of the loss carry forward. But now if the owner gets a heart attack, falls down dead, and the child takes over, then that means nothing else than that the loss carry forward has gone and the child has to begin paying taxes, because the child starts for the trade tax situation a completely new business from scratch. That's awkward. Well, imagine even that would be a loss carry forward of 100 million. So it might be a really enormous relief, which the business needs to come up again. And then the owner dies and everything changes completely. So then the bank gets nervous. For example, when you make your budget plans, you can never be sure, in case of a partnership or a sole tradership, that you can really use all the money which you expect to come in without tax payments, as you expect a loss carry forward to happen, because that might be gone from the 1 second to the next one. If the owner dies, the loss carry forward is gone. So this is only some chance which is probable, but not sure. Huh? Good. Here, by the way, you can have a look to the legal rule, paragraph 2(5) Gewerbesteuergesetz. If a complete business is transferred to a new or different owner, the old business is regarded as having been wound up by the old owner. And in addition to that, the business is regarded as a business which has been completely newly established by the new owner, apart from the cases where it becomes part of an already existing business of the new owner. So, furthermore, we can draw some additional highly interesting conclusions from the wording of that paragraph 2(1). As our law says, we tax a business which is run in the inland. A gain which the owner gets from selling the whole business completely in a single act or from winding it up from liquidation is not covered by the trade tax liability under that rule, because in such a case, that profit does not come from running the business, from operating the business, but from getting rid of it. Handing over the business to somebody else for a price is not really running it, that's getting rid of it. That's not covered by the wording, and so one says this is not taxable. Furthermore, what is a business is said here follows the definition of business income in the GewStG. That automatically leads to the conclusion that not only the basic definition in paragraph 15(2) applies. A business is a sustainable activity where people take part in the market, want to achieve a profit, where it's not agriculture, nor self-employment, and not the mere administration of one's own property, blah, blah. But also that the simplification rules in 15(3) for partnerships apply, especially the rule that if if a partnership runs at least one business activity, then all what the partnership does is regarded as income from business. This leads to the consequence that a partnership does only have one single business, because everything it does is viewed together automatically under that rule. Furthermore, you have now again the problem, what happens if the partnership sells the complete business? Or what happens if, more realistically, one partner sells a share in the partnership? That would again be not a profit which results from running the partnership, but one from getting rid of the share. But now if that partner is in itself a partnership or a GmbH, then let's say one OHG is one of the partners of a KG. Then if the OHG sells its share, then naturally everything what the OHG does during its existence will be regarded as income from business. And so on the level of the OHG, it would again be clear that this is income from business and from running a business. And so it would again be covered by trade tax liability. In the final effect, that means such a tax-free gain from selling a business or a share in a business can only be achieved by a single natural person. If a partner is a GmbH or a partnership again, then we would end up with income from business again. That's clarified in paragraph 7 of the Gewerbesteuergesetz. The trade profit is to be determined as that profit from business according to the rules of GewStG and GewStG, blah blah, and so on. The trade profit also includes the profit from the sale or winding up of an enterprise, a branch, a share, and so on, as far as those do not belong to a natural person as a partner directly involved in that partnership. Good. As you remember, and I already alluded to that during my last remarks, we have also a rule which simplifies the determination of income for a GmbH, an AG, an SE, a limited, if it is unlimited, taxable in Germany, and so on. And that rule was 8.2 GewStG. All income of such a juridical person is deemed to be income from business. That rule was naturally also made with an eye to trade tax, but as every law has to be read alone, we need a kind of a bridge which says, okay, that fiction from GewStG also applies for the purposes of Gewerbesteuergesetz, Trade Tax Act. So we need a rule which, makes that bridge and clarifies that assumption or that fiction is also to be taken into account when you apply the Trade Tax Act. And that other rule is 2.2 Gewerbesteuergesetz, which says this here. The activities of capital companies, especially European societies, public limited companies, private limited companies, SE, AG, cooperatives, including European cooperatives and mutual insurance or pensions associations, are always and in its full extent regarded as a business. Okay, let's go back. What does that mean? Well, that means all the profits are automatically regarded as income from business. Now, as all profits are covered here, strange people could draw the conclusion under a very formalistic aspect that this then covers the worldwide income of a GmbH, because all profits are all profits from everywhere, not only from Germany. If you read the wording exactly, you find that the words from the inland are missing here. So having that in mind, it is plausible that the one or other tax inspector will try to bring forward that strange idea. And for this reason, paragraph 9, number 3, clarifies that that part of the trade profit which refers to a foreign permanent establishment has to be eliminated from the tax base of such institutions in general. Well, as you also see from the wording of 2.2 Gewerbesteuergesetz, profits from selling the whole business are, in that case, in contrast to the basic rule of 2.1, always included in the tax base, because the wording clearly says all income of them is always and in its full extent a business. So always and whatever it is, taxable. Always means from the very first moment of their existence to the very last one. And so if a GmbH winds up its business and sells everything by a liquidation or sells a complete factory to a new owner, this is covered by always and in its full extent. This is regarded as a business activity in the sense of the Trade Tax Act. So this leads to the strange conclusion that in such a case, winding up profits are also covered. So the Gewerbesteuergesetz, the Trade Tax Act, is not neutral with regard to the legal form of the enterprise here. By the way, naturally, we concluded that from my translation here. Now you must be very cautious. A translation is not the original text usually. No, it's never the original text. And so it might be that certain fine and subtle aspects of a wording might only exist in the translation, or on the other hand, that a very fine and subtle aspect of an original wording has not been taken over into the translation because the translating person did not bother about that, or didn't have the focus on that when they wanted to translate. So you can never be really sure when you have a translation and you look to the exact wording, that the exact wording, if it gives you such a supposition like here, if that's really in the original too. So what you have to do in such a case is, when you think about a concrete wording, then take literature at hand, here in that case on German trade tax law, and or alternatively ask German tax advisors or German tax experts about the real legal situation. Is that really correct? Or is that just a fantasy of mine which is only grounded in the translation? In that case, the translation was not so happy. So you have to follow it up. You can never blindly trust into the subtle aspects of a translation. In this case, however, you can trust it. You can take my word on it. This translation here was explicitly made in order to reflect a very fine and clear aspect of the German wording, and it is indeed correctly reflecting the resulting legal situation, because exactly from that always and under all circumstances or so, the German legislation or German jurisdiction also concludes that this covers liquidation profits in the case of a GmbH too. Yeah, now are there any leftovers, ladies and gentlemen? And naturally there should be, otherwise I wouldn't ask. So we have juridical persons which are not covered by 8.2, for example, a private association like a chess club in the legal form of an EV or something like that. You want to tax them if and only as far as they run an economic business. So if an EV, chess club or so, also has a business, economic activities which qualify as a business, then they will also be covered by the trade tax, but only with that business, in contrast to the 8.2 cases in case of a GmbH or AG. Then there is one leftover case, that is the economic businesses which are owned by a public institution. For example, you have a city which runs an own business, for example, an electric power plant and sells you electric current, a bus enterprise for public transport on the area of the city, or a water supply business which is run by the city itself. All that would be a business and would be liable to trade tax under the basic rule again of 2.1 Gewerbesteuergesetz, because it is a business as defined in the GewStG, and so would be applicable, or so trade tax would be applicable. That, by the way, sounds strange to the outsider and to the newcomer, that a city enterprise has to pay taxes to the city, so that the city pays tax to itself. And the answer is naturally, why, oh Lord, do such strange things exist? Well, why? That is made in order to avoid a wrong impression of the profitability of such an enterprise, and to avoid distortions between a public institution and a potential private competitor. For example, when, let's say, the city council has to decide if they run an own bus enterprise, or if they make use of a private bus transportation company, they very often ask themselves how high the profit will be in the one or the other case, and how high, let's say, the subsidies will be which they have to pay. And now imagine a private competitor would probably say, I am willing to do this for a subsidy of, let's say, 500,000 per year, and would have to pay trade tax on that then. That is, by the way, probably the reason why they need to ask for 500,000. Now, if the city runs an own enterprise, let's say they would make a profit of, oh no, they would make a loss probably, and therefore demand a subsidy. Now if they need to pay trade tax, they would also require a subsidy of 500,000 because they would have to pay trade tax, and so they need a higher subsidy. If they get along with a lower subsidy without trade tax, then probably they would make the impression that they were more profitable and so that they would be the better choice. So that would be the wrong decision for the council to take. Let's say if the city enterprise only takes a subsidy of 500,000 but pays no trade tax, then it would be far better to say, let's give the 500,000 subsidy to the private competitor, get back 200,000 in form of trade tax, and so we have taken the better decision for the public budget, and so on. And such distortions are avoided by that. By the way, you probably can forget about that because you will probably never work for a city institution or so. So that's rather a curiosity. Forget about it. That you can legitimately do. But if you really wondered about why the state taxes itself, well, then here is the answer. Okay, let's at the end sum things up. We have taxable businesses of different sorts. First, we have the sole trader, where everything's regulated in 2.1 Gewerbesteuergesetz. Here, the business activity is taxed, and so gains from liquidation are out. Partnerships also are covered by 2.1 Gewerbesteuergesetz. All activities if at least one business activity exists, or if the structure complies with the rule of 15.3 number 2, mainly a GmbH and Co. KG, where no limited partner is appointed as a manager. In all these cases, we have gains from liquidation basically not covered, but if one of the partners is again a partnership or a GmbH, then liquidation gains referring to that partner are also covered by trade tax. Capital companies like GmbHs, SEs, AGs, all activities are always taxable, so gains from liquidation, winding up, selling the whole factory, and so on are always included, because 2.2 Gewerbesteuergesetz says from the first to the last second, and with all imaginable activities. So winding up an enterprise is one of the imaginable activities, so it's covered. Other entities of private law only have to tax economic businesses. And last but not least, the thing which you can in the long run forget again, curiosity, is the economic business run by public law institutions like city, country, a land of the federation or the federation itself would be liable to trade tax under 2.1 and 15.2 GewStG. By the way, the last gray area is one of the reasons why, for example, there are rules in the Trade Tax Act that, let's say, the Deutsche Bundesbank, the German central bank, is free from trade tax, because otherwise it could be classified as covered by this sheet of paper here. Okay, that was enough. I probably talked your ears off completely and they fell down to the ground. So please recover well from this overview about who is taxable, under which circumstances under German trade tax, and then enjoy the time till the next video comes, which again deepens your knowledge, at least I hope so, of German trade tax. Goodbye till the next time, and hope to see you back soon on this channel.